Hey guys, welcome to another tutorial, and in this tutorial I'm just going to tell you some of the most common mistakes that any beginner investor makes when they start out in the market. But before that, I just want to say that if you have made this far to the course, first of all congratulations, because very few people made this far to the course, and if you have made it, then a really big congratulations. And the next thing is, if you have found anything this far, something good or something bad in the course, then please do leave a review of the course. Please give your honest review, because it will help a lot of other students also in analyzing whether to take this course or not. And if you found anything that you think you need to tell me about anything in the course, then feel free to tell me. I reply to each and every query. So now let me just tell you about some of the mistakes. And the first one is the short term horizon. So most of the time, the so-called investors, the traders who think that they are investing for the long term, lose money in order to get high returns. Most of the people lose money in the market because they think that they can just make a lot of money in the short term. And actually, I would not blame them, as when we see stocks going up 10% or 20% in a day, then usually anyone would be tempting to make a lot of money in the short term. But the thing is, it's not as simple as it looks. If stocks go up 20%, then they go down also. And that's where most people lose money. Because not only they buy it at the wrong time, but they do so the same for the selling. Because I've been there, and I can tell you from my experience that don't ever day trade. It's not that you can't make money, but it's extremely difficult. And anyone starting out in the stock market should focus on investing for the long term, probably in index or mutual funds, because that's the way to start. If you want to become a world class athlete, you just can't aim directly for that. You gotta start small but aim for the big. So, similarly, you shouldn't day trade at first, although I don't recommend it for the long term also. But if you seriously want to day trade, then at least start investing first, and then you can go for whatever you like. And in this way, you can make a lot of money also. Now, the next mistake is financial media. So, from my years of experience into the markets, I can tell you that financial media, which basically includes channels and mostly news and advisory services, don't offer much in terms of value. And if you're starting out, then watch all these channels, but not for tips. Never for tips, which is an obvious case for beginners. And I told you I lost almost all my money in 10 days. If I haven't told you, then I'm telling you right now. And that was because I received some really helpful advice and tips from these channels. Think logically. Does Warren Buffett, Seth Klarman, or Peter Lynch come on TV, and does they brag about the stock tips that buy this or sell that? Well, no, they don't come on TV and brag about like buy this or sell that, because they know that it's a wrong way to make money. And stock market gurus who come on TV, the so-called analysts that give you tips, are not anywhere near thinking about your well-being, and they don't care about you. They're just there to make money, but for themselves. And that's why you should only watch these channels to get some news and understand some topics, but never for the tips. Although don't avoid them completely, because most of the times they give some really good news and analyze those news to the viewers, so that the beginners like you could understand them. And that's why they are not a complete turn off, but most of the times they are not worth the time that you invest in them. So don't avoid them completely, but just understand the news. So this one is investing in low priced stocks. So this is the most common mistake a beginner makes when investing in the stock market, because stocks which trade at like 10, 15 or $20 seems to be like the bargain stocks if you look at the absolute prices, but they don't tell you anything whatsoever about their valuation, whether they are undervalued or overvalued. They don't tell anything about that. So you can't tell anything by just looking at the prices. Most of the beginners think that if they are investing $10,000 and if they invest in a $10 stock, then they will be getting 1000 shares. Whereas if they invest in a company like Google, whose stock price is $500, then they will get only 20 shares. And that's it. So they measure the upside in returns by the number of shares that they get. So they think the more the shares they get, the more money they are going to make. And now let me just clear this myth. So first of all, the amount of money that you invest in the market matters. And second of all, the shares that you buy determines the upside, not the number of shares. So for example, two friends, Chris and Harry, started investing in the market with $10,000 each. But Harry was knowledgeable and knew how to invest, and Chris didn't. So Harry chose a great company with huge growth, but the stock price of that company was $500. And seeing this, his friend told him not to invest in the company as the stock price was so high, and that he will be getting only 20 shares. Then Harry told him about several advantages about the company and said that the price is not high. But Chris didn't listen to him. Instead, he said, "If you want to earn your money, so be it. But I'm not investing any money into this company." And then he found a very small company whose share price was $10, but the company's future didn't have huge growth and wasn't fundamentally strong. But Chris didn't listen to anything, and he thought he will be getting more shares if he invests at this price. So he invested in that company and gets 1000 shares. Now fast forward 1 year, Harry makes a good return of 75% on his money in 1 year and is still holding the stock. On the other side, Chris's small cap company got into troubles and filed for bankruptcy. So Chris lost all his money. And the moral of the story is, prices are never a good indicator of company's valuation and growth. Although not every company priced low is bad, it's just that there's no relation with the company's potential as to what the price of the company is. So don't think of investing in low price stocks and making a lot of money. And the last one is calculating the profits. So most of the people don't know about actual profit that they are making. For example, a few months back when I was working in a company and my job was to purchase and sell shares of others, just like brokers, and there was this guy who was buying and selling shares at a very small profit or loss. But the actual fact was he was losing money. Actually, the thing is, he was buying the stock for $55, and I'm actually telling dollars because it would be pretty easy to understand for all of the guys watching the tutorial. Although he was buying and selling in rupees as it was Indian equities, but I'm just using dollars for better understanding so that you can understand. So he was buying at $55 and selling at $55.5 and was thinking that he was making a profit. And now you must be thinking that of course he was making profit if he sold at higher. But he wasn't. You're wrong. Because although he sold at $55.5, but he wasn't considering other taxes and the brokerage that he had to pay, which was 0.5%. That means whenever he buys, he has to pay 0.5% and again 0.5% for selling, which means he has to earn at least 1% just to cover his brokerage fees. And I'm not even talking about all the other taxes like STD, SABI charges, higher reduces, and various other charges. So you can call your broker to know about every other charge. But my point is, most of the beginners make this mistake. So whenever you sell your share, even at a high price, first of all calculate all the charges that you're going to pay and then deduct all those charges from the profits or the total return that you made. And that would be the actual profit you would be making. So these were all of the most common mistakes that any investor makes when they start out in the market, and I thought of telling it to you because I did some of the mistakes which I just told you in the tutorial and I suffered a lot. So I thought of telling you, and that could save you a ton of money and time also. So that's pretty much for this tutorial.